Something strange happened during the Iran crisis that should concern every American who holds dollars, who saves in dollars, who plans their financial future denominated in dollars. It is a signal that most financial media glossed over, a signal that reveals the true condition of the American financial system beneath the surface of dramatic headlines about war and markets. And once you understand what this signal means, you will see that the dollar rally everyone celebrated was not strength at all. It was a warning dressed up as confidence. When geopolitical risk explodes, when war begins, when missiles fly and casualties mount, there is a playbook that global investors follow. It has been followed for decades. It is taught in every finance textbook. It is the foundation of how trillions of dollars move during crises. And that playbook says two things happen simultaneously. First, investors buy US dollars. The dollar is the world's reserve currency. It is the backbone of global finance. When fear rises, when uncertainty spikes, when you do not know what tomorrow brings, you hold dollars. That is the safe haven trade. Second, investors buy U.S. treasuries. Treasury bonds are the deepest, most liquid pool of assets in the world. They are backed by the full faith and credit of the United States government. When everything else is uncertain, treasuries are certain. You buy them, their prices rise, their yields fall. That is how safe haven buying works. The dollar did exactly what the playbook predicted. The DXY index, which tracks the dollar against a basket of 6 major currencies, climbed roughly 1.4% over 2 sessions. It hit 3-month highs. Investors rushed into dollars. The safe haven trade worked perfectly on that side of the equation. But Treasury yields did not fall. They rose. They moved in the opposite direction from what crisis playbooks predict. When bond prices rise, yields fall. When bond prices fall, yields rise. Treasury yields rising during a geopolitical crisis means Treasury prices were falling. Investors were not rushing into bonds for safety. They were doing something else entirely, and that anomaly, that single deviation from the expected pattern, tells you everything about the forces actually driving markets right now. Let me show you exactly why yields rose instead of fell, because the explanation reveals something fundamental about the economic environment we are living in. The explanation is inflation. Oil prices jumped during the first stage of the crisis. Traders immediately began focusing on the inflationary impact of higher energy costs. Oil feeds into everything: transportation, manufacturing, heating, agriculture, plastics, chemicals. When oil prices spike, inflation follows, and inflation erodes the value of fixed income returns. If you buy a treasury bond paying 4% annually and inflation is running at 3%, your real return is only 1%. If inflation rises to 4%, your real return is 0. If inflation rises to 5%, you are actually losing purchasing power by holding that bond. The higher inflation goes, the less attractive bonds become. This is what traders priced in during the first days of the Iran crisis. They saw oil spiking. They calculated the inflation impact. They concluded that holding treasuries was not the safe trade it normally is during geopolitical shocks. They sold bonds or stayed away from them. Prices fell. Yields rose. This is not normal. This has not happened in previous crises. During previous geopolitical shocks, the safe haven trade into treasuries worked exactly as expected. Yields fell, bond prices rose, the pattern was reliable. The pattern breaking tells you something has changed. The inflation psychology has changed. The market's assessment of inflation risk has changed. Even during a war, even during maximum uncertainty, investors are more worried about inflation than they are attracted to the traditional safety of government bonds. Some investors move toward gold instead of treasuries. Gold has approached record highs this year and has increasingly acted as a hedge against both inflation and geopolitical instability. Gold does not pay interest. It does not generate income. Normally, that makes it less attractive than bonds during crises. But if inflation is going to erode bond returns anyway, gold starts looking better. It holds value. It cannot be printed. It does not depend on any government's fiscal discipline. The treasury market remains the global benchmark safe asset. But the reaction during the Iran crisis suggests the safe haven trade is becoming more complex. Investors are making calculations they did not used to make. They are weighing inflation risk against safety. They are choosing gold over bonds in some cases. The automatic flight to treasuries during crises is no longer automatic. Now let me show you why the dollar rally itself was less than meets the eye, because the positioning dynamics reveal this was a squeeze, not a fundamental turn. Traders had been heavily short the dollar since late 2025. They were betting on dollar weakness, and they had good reason. The currency had already fallen roughly 12% against a basket of currencies since the start of 2025. That is an enormous decline for the world's reserve currency. The trend was down. Traders positioned for that trend to continue. When the Iran strikes happened, when geopolitical risk exploded, those short positions became painful. The dollar rose on safe haven demand. If you are short the dollar and the dollar rises, you lose money. The more it rises, the more you lose. At some point, the losses become unbearable and you have to cover your short position. Covering a short means buying dollars, and when many traders cover shorts simultaneously, their buying pushes the dollar even higher. The recent jump in the dollar reflects market positioning rather than a clean flight to safety. That is the assessment from analysts watching the flows. Short covering amplified the rally. The move was partly mechanical, driven by traders unwinding losing positions, not purely driven by genuine demand for dollar safety. This matters because short covering is temporary. Once the shorts are covered, the buying stops. And if the fundamental reasons those traders were short in the first place have not changed, they may rebuild short positions once the crisis fades. The rally becomes a temporary spike rather than a sustained turn. And the fundamental reasons for dollar weakness have not changed. Interest rate expectations still point toward Fed easing. U.S. debt levels are still exploding. The fiscal trajectory is still unsustainable. None of those factors were altered by the Iran strikes. Now let me show you how quickly the rally reversed, because this demonstrates just how headline-sensitive markets have become. On Wednesday, just days after the initial surge, the dollar fell as much as 0.4%. Stocks recovered. Oil prices pulled back from recent highs. What triggered the reversal? A New York Times report that Iran's Ministry of Intelligence had signaled to the U.S. Central Intelligence Agency a willingness to explore talks to end the war. Back-channel communications, diplomatic feelers, the possibility that the conflict might prove shorter-lived than initially feared. That single report reversed a significant portion of the safe haven trade. Investors began unwinding positions they had built just days earlier. The dollar retreat showed that the recent strength was tied closely to geopolitical risk rather than a major change in economic fundamentals. Carl Shimoda, chief market strategist at Corpay, described what happened. Investors are seeing light at the end of the tunnel for the conflict in the Middle East and are unwinding short positions on the currencies most exposed to a sustained commodity price shock. Reports of back-channel communications between U.S. and Iranian intelligence organizations are pairing with President Trump's apparent backpedaling on earlier demands for regime change to reduce the likelihood of a wider regional conflagration. Trump backpedaling on regime change. Diplomatic back-channels opening. Investors suddenly hopeful the war might end sooner. All of it within 72 hours of the initial strikes that were supposed to trigger prolonged conflict. The speed of the reversal tells you something important. Markets have become extremely sensitive to headlines. Investors are operating in an environment where rapid price swings follow every new development. The dollar can surge 1.4% on war fears and give back half of that on a single diplomatic signal. This is not a stable environment. This is not a predictable environment. This is an environment where your currency exposure changes value dramatically based on whatever the next headline says. Now let me show you the European dimension, because the euro's collapse reveals how the conflict affects different regions differently. The euro fell to its weakest level since late November on Tuesday, and the options market shows traders are at their most bearish toward the euro in at least a year, having flipped from an overwhelmingly bullish position just 6 weeks ago. 6 weeks ago, traders were bullish on the euro. They expected it to strengthen. Now they are positioning for further weakness. The cost of buying options to sell the euro against the dollar over the next 3 months relative to the cost of options to buy it is at its largest premium since March last year. The options market is pricing in expectations that the euro has further to fall. Why the dramatic shift? Natural gas. And here in Europe, it is all about the natural gas prices. That assessment from Jeremy Stretch, head of G10 FX strategy at CIBC Capital Markets, captures the core vulnerability. If there comes to be more of a supply as well as a price issue, then obviously that becomes much more problematic for the Eurozone. Europe depends heavily on energy imports. The continent does not have the domestic oil and gas production that the United States has. When Middle East conflicts threaten energy supply, Europe suffers disproportionately. Higher natural gas prices crush European industry. They raise costs for manufacturing. They reduce competitiveness. They slow economic growth. The euro's weakness against the dollar during the Iran crisis reflects this vulnerability. Europe is more exposed to the energy shock than America is. Investors are positioning accordingly. Sell euros, buy dollars. The relative safety of the U.S. with its domestic energy production attracts capital away from an energy-vulnerable Europe. Eurozone inflation accelerated more quickly than expected in February, before the Iran conflict even started. Add energy price pressures from the war on top of already accelerating inflation, and the European Central Bank faces impossible choices. They cannot cut rates to support growth because inflation is too high. They cannot raise rates to fight inflation because the economy is weakening. Europe is stuck. Now, let me show you the long-term pressures on the dollar because the geopolitical crisis is temporary, but the fiscal trajectory is permanent. The United States is running large budget deficits, and those deficits are expected to remain elevated for years. According to projections from the Congressional Budget Office, the federal deficit will reach about 5.9% of GDP by 2030. Public debt will climb to roughly 108% of GDP during the same period and continue rising afterward. 108% of GDP. That is not a crisis number in isolation. Japan has higher debt to GDP and remains functional. But the trajectory matters. The debt is not stabilizing, it is climbing, and the interest payments on that debt are becoming one of the fastest growing components of government spending. The CBO estimates that net interest costs will reach about 3.8% of GDP by 2030 and exceed $2 trillion annually by the mid-2030s. $2 trillion per year just on interest payments. That is more than the current defense budget. That is more than Medicare spending. That is money flowing to bondholders rather than to government services or taxpayer relief. With the U.S. population aging, healthcare spending continues to rise. Social Security costs will increase as more Americans retire. The fiscal pressures are structural. They are not going away. They will intensify over time. For financial markets, the issue is not an immediate debt crisis. Investors still view U.S. Treasuries as highly secure assets. The challenge lies in the steady expansion of borrowing needs over time. More borrowing means more bond issuance. More bond supply means downward pressure on prices. Downward pressure on prices means upward pressure on yields. Upward pressure on yields means higher borrowing costs for the government. Higher borrowing costs mean larger deficits. Larger deficits mean more borrowing. The cycle feeds on itself. This fiscal backdrop is one reason FX strategists largely maintain their view that the dollar will weaken over time. The geopolitical shock provides temporary support. It triggers safe haven buying. It squeezes out short positions. But it does not change the fundamental trajectory of American fiscal policy. Once the crisis fades, once the war premium dissipates, the underlying pressures reassert themselves. Now let me show you how war costs add to the fiscal picture because military operations are expensive and they are financed through borrowing. Wars rarely damage economies immediately. Their financial impact tends to appear gradually through rising government spending. Operational costs for military deployments can reach $25 million to $40 million per day, even before combat begins. A prolonged conflict would require additional spending on logistics, equipment, and missile defense systems. History offers several examples. The wars in Iraq and Afghanistan were largely financed through borrowing rather than new taxes. Government debt increased steadily during those years, even though the U.S. economy continued to grow. The costs accumulated over 2 decades. They contributed to the debt trajectory that the CBO is now projecting forward. Today, the fiscal starting point is far less comfortable. U.S. government debt stands near 123% of GDP. That is before any war costs are added. Any military operation in the Middle East adds to spending. That spending gets financed through Treasury issuance. That issuance adds to the debt. That debt adds to interest payments, the fiscal pressure compounds. The country can sustain high borrowing levels because global investors continue to buy treasuries. That reliance on investor confidence remains an important factor. If confidence wavers, if investors demand higher yields to hold American debt, if the safe haven status erodes, the entire fiscal edifice becomes more expensive to maintain. The broader question is not whether the dollar will collapse during a conflict. The question is how persistent deficits, rising interest payments, and geopolitical commitments interact over the long run. Investors tend to focus on those slow-moving forces once the headlines fade. Now let me show you the oil price scenarios because energy sits at the center of the economic consequences of the Iran conflict. The Middle East remains one of the most important regions for global energy supply. Research from the Center for Strategic and International Studies outlines several escalation scenarios and their implications for oil prices. A modest disruption to Iranian exports could push oil prices roughly $10 to $12 higher per barrel. That is the mild scenario. Iranian production gets reduced. Other producers do not fully compensate. Prices rise but remain manageable. A larger disruption to tanker traffic in the Persian Gulf could drive prices above $90. This is the moderate scenario. The Strait of Hormuz gets partially restricted. Tanker insurance becomes prohibitively expensive. Some shipping stops. Supply tightens significantly. More severe attacks on infrastructure could lift prices well above $100. This is the severe scenario. Production facilities get damaged, refineries get hit, the physical ability to produce and process oil is impaired, prices spike dramatically, higher oil prices flow quickly through the global economy, they raise transportation costs, they push inflation higher, they often force central banks to remain cautious about cutting interest rates. The Federal Reserve already faces a complicated situation. Inflation has moderated compared with earlier peaks, but remains above the central bank's target. Any new energy shock could delay rate cuts and keep financial conditions tighter for longer. In that sense, the Iran conflict matters less because of military costs and more because of its potential to influence inflation expectations. The inflation transmission mechanism, from oil to transportation to consumer prices, runs regardless of military outcomes. As long as oil stays elevated, inflation pressure persists. As long as inflation pressure persists, the Fed cannot cut rates confidently. As long as the Fed cannot cut, borrowing costs stay high. Now let me show you why interest rate expectations still point toward eventual dollar weakness, because the geopolitical shock does not eliminate the underlying trend. Over the past decade, the U.S. currency benefited from relatively high interest rates compared with other developed economies. When the Fed raised rates while other central banks held steady or cut, capital flowed into dollar assets to capture the higher yields. That interest rate differential was one of the strongest supports for dollar strength. That advantage is narrowing. Markets still expect the Federal Reserve to begin easing policy during the next phase of the economic cycle. The exact timing remains uncertain, particularly if inflation proves stubborn. But the direction of travel is widely understood. Rates are going down eventually. The question is when, not whether. Federal Reserve official Williams indicated that cooling inflation could pave the way for further interest rate cuts in the future. That statement came during the Iran crisis. Even while war was raging, even while oil was spiking, a senior Fed official was talking about eventual rate cuts. The underlying expectation remains that the easing cycle will resume once conditions permit. When U.S. interest rates fall relative to those of other countries, the yield advantage of dollar assets declines. Investors often begin to look elsewhere for returns. Capital flows out of dollars and into currencies offering better relative yields. The dollar weakens. This dynamic has played out repeatedly in previous currency cycles. The pattern is well established. The current geopolitical shock may delay that process for a time. It provides temporary support through safe haven flows, but it does not eliminate the underlying trend. FX strategists largely maintain their view that the dollar will weaken over time. The recent rally looks less like a fundamental turn and more like a positioning squeeze triggered by geopolitical risk and rising oil prices. Once the risk premium fades, once the shorts are rebuilt, once the fundamental pressures reassert themselves, the dollar resumes its trajectory. Now let me show you the economic data that got overshadowed because strong numbers arrived just as everyone was watching the war. The dollar showed little reaction to data showing U.S. private payrolls increased by the most in 7 months in February. Private employment rose by 63,000 jobs last month, the largest gain since July 2025, after a downwardly revised 11,000 increase in January. That is meaningful improvement in the labor market. Under normal circumstances, it would move markets, but with the Iran war dominating attention, the data barely registered. A report showing U.S. services sector activity surging to more than a 3.5-year high in February also had marginal impact on the currency market. The Institute for Supply Management said its non-manufacturing purchasing managers index increased to 56.1 last month, the highest reading since July 2022, from 53.8 in January. Economists polled by Reuters had forecast the services PMI easing to 53.5. Instead, it surged. These are strong economic numbers. Job creation accelerating. Services activity at multi-year highs. Under normal circumstances, strong data would support the dollar, but the geopolitical noise overwhelmed the signal. Markets were focused on Iran, on oil, on diplomacy, on whether the war would expand or contract. The economic fundamentals got lost in the headlines. This creates an information asymmetry. Professional traders know the data was strong. Retail investors focused on war headlines may not realize the underlying economy showed signs of resilience. When the war premium fades, when attention returns to fundamentals, the strong data may provide delayed support for the currency. Or the data may get revised, or the next month may disappoint. The uncertainty compounds. Now let me bring all of this together, because the picture is more complicated than any single narrative suggests. The dollar surged on war fears. That surge was amplified by short covering as heavily positioned traders unwound losing bets. Treasury yields rose instead of fell because inflation concerns outweighed safe haven demand. Gold captured some of the safety flows that normally go to treasuries. The euro collapsed as Europe's energy vulnerability became apparent. Then the dollar reversed on diplomatic signals. Back-channel talks between Iranian and American intelligence, Trump backpedaling on regime change, hopes that the conflict might prove shorter-lived than feared. The safe haven premium began unwinding as quickly as it had built. Underneath all of this, the structural pressures on the dollar remain unchanged. Deficits at 5.9% of GDP by 2030, debt climbing to 108% of GDP, interest payments reaching $2 trillion annually by the mid-2030s. The Fed still expected to cut rates eventually. The interest rate advantage that supported dollar strength still narrowing over time. The geopolitical shock provided temporary support. It did not change fundamentals. The war premium is real, but it is not permanent. Once the conflict resolves, once the oil shock fades, once inflation fears moderate, the underlying trajectory reasserts itself. And here is what this means for you specifically. The dollar in your savings account, the dollar that denominates your salary, the dollar that you use to buy everything from groceries to gasoline, is being buffeted by forces that swing violently based on headlines. One day, the dollar surges because war breaks out. The next day, it falls because diplomats make phone calls. The long-term trend still points toward weakness because of fiscal dynamics that no single crisis can change. Your purchasing power depends on all of this. A weaker dollar over time means imports cost more. It means inflation stays elevated. It means the standard of living that dollars can buy gradually erodes. A stronger dollar during crisis provides temporary relief, but does not address the underlying pressures. The Treasury market signaling inflation concern during a war tells you that even the traditional safe havens are not behaving normally. Gold rising as an alternative tells you sophisticated investors are hedging against scenarios that used to be unthinkable. The options market flipping to maximum bearishness on the euro in just 6 weeks tells you how quickly sentiment can change. This is the environment in which your financial decisions are being made. Violent swings on headlines, structural pressures building over years, inflation eroding returns even on safe assets, traditional relationships breaking down, no clear path forward. I am not a financial advisor, and nothing I say should be taken as financial advice. But what I can tell you is that the dollar rally everyone celebrated was not pure strength. It was a positioning squeeze amplified by war premium. The Treasury yields rising during a crisis was not normal. It was an inflation signal that shows even safe haven trades are becoming complicated. And the reversal on diplomatic signals shows how quickly everything can change when the next headline hits. The dollar surged, then it fell. Treasury yields rose when they should have fallen. Gold approached records, the euro collapsed, and all of it can reverse again tomorrow based on whatever Iran or Trump or the CIA or the markets decide to do next. This is currency markets in 2026. Volatile, headline-driven, disconnected from fundamentals in the short term but still beholden to them over the long term. And the long-term fundamentals, the deficits, the debt, the interest payments, the eventual Fed easing, all of it still points toward dollar weakness once the noise clears. Subscribe to Market Acme right now and join our WhatsApp community for real-time updates because currency markets are moving on every headline, and the difference between understanding what is happening and being caught by surprise is measured in purchasing power, in savings value, in financial security. I am Kenzo John. I am not a financial advisor. This is Market Acme. And I will keep showing you what the dollar movements actually reveal, what the Treasury signals actually mean, what the positioning dynamics actually show, and what the gap between headline reaction and fundamental reality tells you about the forces shaping your financial future. The dollar surge looked like strength. It was a squeeze. The Treasury yield rise looked strange. It was an inflation signal. The reversal looked sudden. It was markets repricing on diplomatic hopes. And the underlying trajectory, deficits at 5.9%, debt at 108%, interest at $2 trillion, none of that changed because missiles flew and back channels opened. The war premium is temporary, the fiscal pressures are permanent, and your financial planning needs to account for both while remaining flexible enough to adapt when the next headline arrives and everything reprices again. Join our WhatsApp community for updates because when the Iran talks progress or collapse, when the next inflation reading arrives, when the next Fed official speaks, when the next positioning data reveals what traders are actually doing, you need to understand what it means immediately. The dollar surge or war premium question has been answered. It was both, and it was neither permanently. The underlying trend remains what it was before the missiles flew, and that trend, driven by fiscal dynamics that no single war can change, still points toward long-term dollar weakness that will affect your purchasing power for years to come. Understand the dynamics, watch the headlines, but never forget the fundamentals, because when the headlines fade, the fundamentals are all that remain.